now let's turn our attention to Urban Company. Now, as a business, I suppose most of us have, had a touch and feel, had an experience. But to really understand what this company is all about in terms of its financials, its business model, and the asking valuations in the IPO, let's go across to Manglam. Manglam.
Product, rather service that everyone knows about, at least in the top cities of the country. They are formalizing an otherwise informal service economy. The issue opens today. They're raising about 1,900 crores. That's the issue size, of which 854 crores have been raised via the anchor investors already, which include the likes of Nomura, Aditya Birla Sun Life, ICICI Pru, Helios, SBI Life, etc. And it's a 1,900 crore issue, of which the offer for sale is 1,400 crores. The fresh issue is about 472 crores, which will be invested right back into the business of the company. The earlier investors are actually the ones who are selling. None of the promoters are offering any shares in the OFS. The price band between 98 to 103. At the higher end, it values the company closer to 14,800 crores as the market cap. If you look at their revenues, they've compounded over 30% over the last few years. So 600 crores has turned into around 1,150 crores in the last 3 years or so. And on an adjusted basis, the EBITDA has turned profitable for the first time in FY25 at 12 crores. And they've reported a profit of 240 crores in FY25. But remember, this is on account of a non-cash change that they've done in their deferred tax assets. So the biggest opportunity for them. They're currently present in 47 cities, and they have the potential to expand all the way up to 200 cities by FY30. And the market that they're in is largely unorganized, so that shift is extremely crucial. But apart from the services business, what they're also looking at is the hardware business. So they've, entered water purifier, locks, etc. under the native brand. So that is another revenue vertical for them. And the international business, where they're growing right now, accounts for 10% of their overall services or overall business. Let's see whether that can scale up further or not. As of, annually, they do about 5 to 6 million users. So users increasing is something that we'll be watching out for as well. The question for all of this, how much are you paying? If you assume a revenue CAGR, which continues over the next few years at 35%, and the EBITDA margins, adjusted EBITDA margins crosses 3%, then you are looking at the company being offered at 7 times sales, 4.5 times EBITDA, and 60 times FY27 profit. So obviously not particularly cheap, but the growth runway is fairly long.
Yeah, but that's the thing with these platform businesses, right? They rarely come cheap because of the promise of long-term growth. But Manglam, thank you very much for that. That really sets us up nicely for our next conversation. Abhiraj Singh Bhal, Chairperson, MD and CEO of Urban Company is with us. Abhiraj, great to have you in, and yours is a business that a lot of people would be looking forward to, in terms of in the public listed markets as well. So let's start right there. The last couple of years, you've been growing your top line at over 30%, in some years 35%. Now, for how long can you continue at such run rates? Because the runway for growth is so long. And the point that Manglam made on the profit, you did show up a profit in the previous year, but that was because of the technical factor, like he mentioned, the deferred tax, assets entry. When do you genuinely, business-wise, when do you see complete profitability?
Thank you very much for inviting me. If I talk about Urban Company's financials in the last few financial years, we have improved our revenue from operations, which was about 437.5 crores in FY22 to about 1,144.5 crores in FY25. And if you look at that 707 crores of incremental revenue that we've added to the top line, we've seen a translation of about 385 crores of that moving to the adjusted EBITDA. Adjusted EBITDA moving from negative 373 crores in FY22 to positive 12, and more than 500 crores getting translated to the profit before tax, which was negative 514 crores in FY22 and is now about 28.6 crores in FY25. We don't look at the deferred tax asset. You're right, that would give an unfair picture to the investors. So I would say, broadly speaking, the company has turned a corner and is sort of at a break-even stage. We've grown well in the last few financial years, but we believe that the opportunity ahead of us is tremendous. Less than 1% of the home services sector in India is organized and online. Most of that share would be attributable to Urban Company. But we really see the opportunity for us to organize this industry, to bring in standards, quality control, reliability, and take a significant chunk of this industry online over the next 10, 20 years.
So would it be fair to say, Abhiraj, that you can keep growing at over 30% for, say, the next 3 to 5 years?
I think it would be difficult for me to give specific guidance on growth numbers. But what I can say is that we are a company which is working hard to innovate on our customer offerings, to innovate on the promise that we offer to service professionals of higher earnings and social security. And it is very much our ambition to continue to grow at the same clip that we have been growing for the last few years.
Abhiraj, good morning. Prashant here. Good to see you, and good to finally, I think we'll to talk about urban company in the listed universe. I just want to say that you guys came out with an advertisement a couple of months ago, 2 months ago, talking about. I think it was very nice, nicely done, and that talked about this worker who migrated from Bihar to a big city and came to service the AC. I mean, really talked about dignity of labor, and I think it touched a chord with many that I know. So kudos. The other bit, of course, is I think in terms of what we broadly describe as gig workers, urban companies also rated higher amongst employees, etc., in terms of lesser complaints and job satisfaction, etc. So continue on that path. So just a quick sense on how you see your business progressing from here, Abhiraj. You said less than 1% of what you do is organized. I mean, everything else is unorganized right now. So the mission or your job is to organize this and provide a sort of quality of service at a certain price level, etc. Right? That's how one should think about this. So you're not competing with the local. I mean, of course, you're competing as well, but you're trying to organize more and more of these. Would this basically lead to lower and lower price? Would this necessarily mean lower pricing as we go along, as you continue on this journey, Abhiraj?
Prashant, firstly, absolute pleasure to interact with you. I've been following you for many years.
Thank you.
You're right. I think what we see our role as is organizing this industry, helping customers avail a standardized, high-quality experience at home, and also empowering service professionals who join the platform with the promise of better earnings. Typically, our service professionals make anywhere between 30 to 50% higher than what they would make in the offline world right off the bat. They also have clear career progression. They undergo skill-based training and they get certified. They have access to a life, accidental, and health insurance cover. So it's a way for them to formalize and become part of the formal mainstream economy of India. And to that extent, I think the 99% that remains unorganized and fragmented and local, more than competition, we see them as future partners in this journey for us. And the onus is on us to work hard and create livelihood opportunities for them, which are attractive, and give them the opportunity to upskill and move up in their career and deliver those superlative experiences for consumers. As far as pricing is concerned, with densification of our network, we are able to utilize service professionals better. Service professionals spend less time traveling between jobs or waiting for jobs and more time at home delivering orders. And consequently, the entire systemic cost to serve comes down, which results in two things: A, higher earnings for service professionals, and B, lower pricing for end consumers. And we've seen this play out in some of our high density micro markets in the top cities. So that will definitely be our goal.
Just one quick question, one more quick question, Abhiraj. Are you in most categories where you want to be, or there as well, I mean, you will continue to expand offerings?
I think there are several categories that we have not yet entered, and we would like to expand our offering into it. I think we started with, on-demand home services, which are used maybe once a month or once in 2 months. Services like beauty, plumbing, carpentry, deep cleaning, appliance repair, etc. We've recently entered into more high-frequency use cases with InstaHelp, where we offer a trained a high-quality house help worker at your doorstep in a matter of 30 minutes or less. This is currently being rolled out as we speak. It's very nascent, only a few months old. And there are multiple use cases in the future around InstaHelp that we will also look to offer. Fundamentally, if you think about it, Prashant, any service that can be delivered in the four walls of your home, where a trained service professional can come and deliver that service, we see that as our playing field. And it's very much our long-term ambition to offer all of those services through our platform.
I can tell you this, Abhiraj, that InstaHelp has been noticed by your existing customers already, even before, so, big marketing blitzkrieg taking place. But yeah, that's the innovation, looking at all kinds of services, as Abhiraj pointed out.
Well, Abhiraj, good to speak to you. This is Nigel on this side. I've used your services, amazing. Great to see the way you'll have scaled up the business. And I'm sure the shareholders that are looking to be part of the entity will be hoping for a very, very good experience. So that's all on you. That said, a couple of questions then. Native, that scaled up very, very well in the last few years. Brilliant scale up is what you've seen. But, obviously you'll have a bigger plan out here. How large can it become? And by when do you see, at what revenue level do you believe that it turns profitable?
Nigel, thanks for that question. So, Native was launched a couple of years back by us.
Yes.
We offer two products there, smart water purifiers and smart electronic door locks. We believe both these products have very strong synergy with our platform and our service ecosystem. It's growing very well. Margins have been improving. It's loss-making today, but margins have been improving. Entire last year, it had a negative 33.5% EBITDA margin as a percentage of net revenue. In the first quarter, that came down to about 15-16% negative EBITDA margin. We believe operating leverage will play out here as well. And as we continue to scale, Native will eventually become profitable and can over time become very profitable. Two advantages we have in Native vis-a-vis any traditional player is, one, a meaningful percentage of the sales comes from our own platform. And in some sense, that's all sort of free for us. We don't have to pay a retailer any commissions or channel margins there. And two, we all leverage our existing service network, which is already built out for water purifier servicing and repair, to cater to our customers in Native. I think those are two structural advantages that we have. We want to position Native as a full stack brand, just like our full stack platform, where we own the consumer journey end to end, from sales on our platform all the way to after sales service.
Okay.
Over time, builder. Think of it as a connected ecosystem in your
Got it.
of devices.
All right. Abhiraj, final question from my end before I let you go. In the pre-IPO space, people appreciate a good idea. They like scalability. Once the company is listed, all eyes are on profitability. So is that going to be one of the top draws that you're looking at?
I would say it's very important for us to continue to grow well and make sure that that growth happens at the back of profitability. Particularly for our core services business in India, which is already profitable at about 10% EBITDA margin last year. We would like to continue to compound it and show margin expansion. I think some of our new bets, like Native and InstaHelp, will still require investments. And again, the goal there will be to build those out in a capital efficient fashion. We have very much eyes long-term on not just growth, but also profitable growth and delivering profitability. I firmly believe that eventually companies will be measured on PAT and cash flows to that extent. Even all the other metrics like EBITDA or adjusted EBITDA are just three measures to show investors the pathway to those eventual cash flows and PAT.
Abhiraj, compliments to you. You're speaking a language that the listed public market really understands. And we've traveled such a distance from the time the first platform companies hit the street. I think what you're saying is going to go very well down with people who understand and what they need to see in the P&L. Quick final question on the margin profile and what you're looking to build. Because on one hand, there is the Native business, which keeps scaling up. Right now, it's 10% of your India revenue. You are also in international markets like, I think, UAE and Singapore. So not sure if you're able to charge higher for services there. And then you look at simultaneously expanding in local Indian markets, tier 2, maybe tier 3. So as you combine all of this, will it be dilutive? Will expansion into India be margin dilutive? Will it be offset by your international operations, just trying to understand, how you'll drive the margin and what would be an aspirational, sustainable margin band for you.
So we look at really 4 segments of business, 3 which we have already reported in our RHP. India Consumer Services, Native, and International. Most likely, starting the first earnings call, we will add a 4th, which is InstaHelp. And across these 4 business segments, what we will hold ourselves accountable to is clearly communicating to investors where we are in the journey. How is the top line progressing? How are the contribution margins and EBITDA margins progressing? And if segments are currently loss-making, what is the pathway for them to become profitable? How much time will it take and how much capital will it take before they turn profitable? India Consumer Services is already profitable. There, I think we have to continue to grow it with further profitability, whether we enter into newer cities or newer categories. That margin expansion has to play out there. As far as Native, International, and InstaHelp is concerned, I think in those segments, we will clearly call out where they are today and what the path will be towards profitability.
That's in the first quarter call, right?
That is first.
Yes. We look forward to it, and of course, look forward to speaking with you as well. Good luck with the issue. I'm sure you'll do well. Thanks very much, Abhiraj, for joining us here on CNBC TV18. Thanks indeed.